Greetings from all of us here at Wespath. Thank you for joining us today to review the quarterly performance and hear the latest from our team. We truly value our partnerships with you. My name is Joe Halwax, Managing Director of Wespath's Institutional Investment Services team. I am here at Wespath's office in Glenview, Illinois, bringing you our first quarter 2023 update. After a historic down year for the markets, the first quarter was still somewhat volatile. However, the U.S. economy is proving resilient. This has been especially evident in employment data, showing strength despite 5% of rate hikes over the past year. Inflation is still too high, yet cooling, and given the banking crisis from March, it seems likelier that the end of rate hikes in this cycle is near. It's becoming clear that the stock and bond markets are also pricing in the end of rate hikes. Despite experiencing large swings in the first quarter, both ended with solid gains as this anticipation grows. I'll offer more on that perspective in a market update shortly. First, a brief update on what's going on at Wespath. Our CIO, Dave Zellner, who you will hear from later, recently published an excellent piece detailing our perspective on investing in international companies. International equities in particular have experienced a rough stretch compared to their U.S. counterparts in recent years. But Dave highlights some key reasons to remain optimistic about opportunities abroad. Also this quarter, the Wespath team released our refreshed investment beliefs. This document contains 5 belief statements, down from our previous 10, but still integrating all the convictions reflected from our previous beliefs. It wasn't a change in approach so much as it was an improvement on communicating that approach with you all. And my colleagues Trent and Amy wrote a great recap, which is up on our blog as well. I encourage you to check it out. Now, for what's coming up next. Today, my colleague Karen Manczko will review the performance of our funds. A new webinar contributor, Trent Sparrow, will discuss impact investments, and Dave Zellner will close it out with an economic update. We remind viewers that all of these segments are available individually on our website. Thank you for joining, and let's get started. After so much volatility last year, it is refreshing to report positive numbers for Q1. As I've addressed in previous webinars, 2022 was a very rare year where both stocks and bonds were down double digits. But recall that in Q4 of last year, it actually ended with stocks and bonds both higher. This rally occurred as inflation peaked, and then investors began pricing in easier monetary policy, feeling that the possibility of recession was still far enough distant in the future. In the first quarter, those same themes continued to dominate markets, and we again have positive returns for both stocks and bonds, stringing together 2 consecutive quarters. In March, we saw a very large and very real crack in the banking system that resulted in 2 banks being taken into receivership. A government backstop facility was also put into place to prevent contagion. However, along with inflation and the path of interest rates, investors will be looking for the continued fallout from the March bank crisis. Some questions to consider are, will similar weak banks need to be shut down? Will credit remain very tight and choke off growth? And what will the impact be on corporate earnings? And finally, will there be pressure on sensitive asset classes like commercial real estate? Turning to market performance, the S&P 500 was up 7.5% on the quarter. And looking at the details of the U.S. stock market, there was a wide variance. Roughly 15 stocks accounted for nearly all the gains in the S&P 500. And you can see the mega cap index we track was up over 29%. The biggest winners were Nvidia at 81% and Meta at 68%. Small caps, seen in the Russell 2000, were up just under 3%. So again, a wide disparity versus large caps. The most logical explanation is that the larger tech and consumer discretionary stocks rallied as investors rotated out of financials after the March crisis, with the bank indexes down just under 20%. With the yield curve shifting lower, the mega cap stocks benefited as they're more sensitive to rates. I will also note that the tech industry has very publicly cut their labor force and many of the fancy benefits they once flaunted. This shift in focus to profitability also helps explain their strong quarter. Note that since the current bear market low of 2022, the S&P 500 has bounced back 14.7%. But valuations have also crept up, as illustrated in this next slide. You can see that the S&P, with the price to earnings at 17.8, we are above the 25-year average of 16.8. International equities were positive on the quarter, with the MSCI Equity Index up 8.5%, higher than the S&P 500, despite having more exposure to financials and less to technology. Emerging market stocks at one point were up 12% in January because of China's reopening, and eventually closed the quarter up around 4%. Similar to equities broadly, international and EM stocks sold off during the March bank crisis, but bounced back a bit near the end of the quarter as both contagion and recession fears have eased. Both international and emerging markets remain attractive given cheaper valuations than the US, which you can see on this slide. The chart on the left shows that historically, they are a full 2 standard deviations cheaper compared to US stocks based on price to earning ratios. The chart on the right shows that dividends are also higher for international stocks. Meanwhile, the dollar was about flat in the first quarter. But remember, it is roughly 10% lower than at peak levels witnessed in the fall of last year. A flat to weaker dollar will be supportive of international stocks. Lastly, on this topic, this slide is a slide we've shown in previous webinars from JP Morgan, focusing on the length of outperformance from US to international stocks. This slide shows that outperformance historically has occurred in cycles of varying length. Currently, we are in year 14 of the cycle, which is the longest seen in 50 years. You can also see that this outperformance accelerated in the past 3 years, which can be attributed in part to the amount of stimulus that the US put in relative to the rest of the world. So, cheaper valuations, a flat to weaker dollar, and the length of the current cycle provide some reasons to remain optimistic about international and emerging market stocks. As I mentioned in the org update, Dave shared even more reflections with international opportunities in a recent blog, which you should check out. Now, on to fixed income. The bond index has posted their second consecutive quarter of positive returns, with a 3.3% gain in the international aggregate and a 3% gain in the US aggregate. The only negative on this chart is commodities, which were lower by 5.3%, but are moving higher in April. The OPEC production cut is pushing oil prices and commodities broadly higher. Let's conclude with a look at the movement in the yield curve. The green line is June 2022, early into the rate hiking cycle with an upward sloping yield curve. The blue line is the start to 2023, and the orange line was the end of Q1. You can see that in the first 3 months that the yield curve has shifted lower from 1 year out as investors are starting to price in a slower economy. The yield curve has also become more inverted as the Fed continues to hike rates. One of the conundrums in the market today is that the bond and stock markets are pricing in very different things. While the inverted yield curve signals recession, stocks have rallied and are either ignoring or pricing in those risks. Another conundrum is that the Fed continues to signal there will be no rate hikes in 2023, but the market is pricing in 3 to 4 rate cuts by the end of 2023. Let me close with a few thoughts. After last year's volatile and sharply lower markets, we now have another quarter of gains. As we've noted in previous webinars, it's rare to have 2 consecutive years of negative returns. Markets have now shrugged off the banking crisis, but we will continue to watch for another round of pressure and the impact on both the credit markets and earnings. Economic focus is shifting from inflation to both economic and earnings growth, which we will continue to watch closely. It's unlikely that the next decade will look like the previous decade, as leadership, particularly in stock sectors and frequently in countries, has always rotated. Wespath builds globally balanced and diversified portfolios that seek to allow investors to take advantage of the next market leaders and avoid the highs and lows of being overly concentrated. We continue to believe that investors should stay the course, remain invested, and focus on long-term results. I'm joined by my colleague Karen Manczko, who will provide an update on the Wespath Fund's performance. Karen, thanks for being here.
Thanks, Joe, and hello, everyone. It's great to be here today.
The markets were positive for the second consecutive quarter after having an extremely volatile 2022. Given these positive results, how did the Wespath funds perform for the quarter?
That's correct, Joe. Though despite this positivity, there was still quite a bit of turbulence within the quarter. After inflation slowed for the 6th month straight in December, investors began the year optimistic that the Fed's rate hikes would be coming to an end soon. With this said, the U.S. markets were up roughly 7% and international markets were up 8% in January. Moving into the month of February, inflation proved to be a bit sticky, resulting in concerns that the Fed would need to continue a more hawkish stance in the near term. The U.S. markets ended the month down 2.3%, and international markets were down 3.4%. As we entered the final month of the quarter, the financial sector came under considerable pressure after 2 U.S. regional banks failed and Credit Suisse was rescued by UBS. Fortunately, the U.S. markets ended the month of March up 2.7%, and international equities were up 2.1%. With this said, you can see that the Wespath equity funds ended the quarter in positive territory, with both our U.S. and international equity fund up 6.8% to 7.3% net of all fees. I'll review the individual contributors and detractors of the fund's performance here in a moment.
So Karen, it looks like fixed income also had a positive quarter. What can you tell us about those funds?
Of course, similar to the equity funds, the bond market also had some mixed results due to inflation coming in higher than expected in February, and then the bank turmoil pushing yields down, which supported the bond prices in the month of March. You can see on the chart that the fixed income fund and the inflation protection fund ended the first quarter positively. The positive performance of both our equity and fixed income fund led to our flagship balanced portfolio, the multiple asset fund, ending the quarter in positive territory.
Thanks for that update, Karen. Can you tell us about trailing results?
Yes, it's great to see the funds end the quarter in positive territory. Unfortunately, the gains we saw did not fully offset the declines we experienced in both stocks and bonds last year. But returns have improved since the end of 2022. If you look at the 3-year, you see that the multiple asset fund was up over 10% net of all fees, and the equity funds posting strong double-digit absolute returns.
So Karen, before we move on to the next chart, are there any other updates on the funds that you wanted to share?
I just have one update that I want to note. In February, we updated the benchmark for the Inflation Protection Fund. This fund is a unique fund and was created to protect our clients' portfolios against unanticipated long-term inflation while providing income. The fund has diverse holdings, and there aren't ready-made benchmarks currently on the market that encompasses the underlying strategies within the fund. Therefore, we've created a custom benchmark. The prior benchmark included both U.S. and non-U.S. inflation-linked bonds, plus had an allocation to commodities. The beginning of February, we adjusted the benchmark to remove the non-U.S. inflation-linked bonds. Therefore, the benchmark is comprised of U.S. Treasury inflation-protected securities and commodities. The rationale for the new benchmark is that it has fewer components, which makes it easier to understand. It's more comparable to our peers and better reflects the exposures of the fund.
Thanks for that update, Karen. So moving on, earlier you showed us how the multiple asset fund compared relative to its benchmark. How did it compare relative to other balanced funds?
This chart showcases the multiple asset fund versus a universe of balanced funds. This slide measures how our balanced fund performed relative to other balanced portfolios and funds that are currently on the market. We're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. Looking at the chart, you can see the multiple asset fund has performed in line with the median for the 1 year and above the median for the 3, 5, and 10-year time horizons. For instance, the 10-year time horizon, the multiple asset fund outperformed 59% of its peers.
Can you tell us about the individual contributors and detractors for the first quarter?
Yeah, starting with our multiple asset fund, the fund outperformed by 9 basis points in the first quarter. The primary contributor to the fund's performance was the outperformance by our international equity fund and our fixed income fund, which together make up 55% of the multiple asset fund.
So you mentioned earlier that despite the quarter being volatile, the equity markets ended in positive territory. How did our equity funds perform in the first quarter on a relative basis?
Starting and looking at the U.S. equity fund, this fund modestly underperformed its benchmark by 28 basis points for the quarter. But let's start with the positives. During the quarter, we saw value stocks underperform growth, which was primarily due to the decline in financials and specifically regional banks, which are value companies. Therefore, the fund's underweight to large cap value stocks contributed to the performance. Also contributing positively was the outperformance of our active managers within the fund due to their strong stock selection in information technology and consumer discretionary sectors.
It's particularly interesting, given that I recently read an article in the Wall Street Journal stating that most active managers struggled in the first quarter due to their bearish positioning. It's great to hear that our active managers did well in this market. Any further updates on the U.S. equity fund?
I do quickly want to note the detractors to the performance. Unfortunately, the contributions I noted earlier were offset by the fund's underweight to mega cap stocks, which were up 29% for the quarter. Also, the fund's overweight allocation to small and mid-cap value stocks detracted. Finally, the fund's allocation to private equity and private real estate modestly detracted since these asset classes typically lag when there's a strong public market.
So in the month of March, the decline in regional banks like Silicon Valley Bank and Signature Banks, it dominated the headlines. Did Wespath have any investments in these banks?
The U.S. equity fund had a very modest allocation to these two banks, which did not materially impact the fund's performance. It is worth noting that none of our active managers had allocations to these banks. We held these positions in our passive strategies within the fund. Now turning our attention to the International Equity Fund. This fund outperformed its benchmark by 63 basis points. Similar to the U.S. equity fund, the fund's active manager stock selection in information technology and consumer discretionary contributed to the strong outperformance. Modest detractors to the fund performance were the fund's allocation to international private equity and private real estate and our ethical exclusions.
Thanks for that. So let's move on now to highlight the first quarter performance of our fixed income funds.
The fixed income fund outperformed by 18 basis points for the quarter. The fund's allocation to emerging market debt contributed as we saw the dollar depreciate in the first quarter, and also the reopening of China was a positive contributor to the performance. Also, the investment manager's issue selection, particularly in the Mexican peso, contributed. The fund's Core Plus manager had strong issue selection, along with the allocation to investment-grade credit, as we saw spreads tighten in the first quarter, which was positive for performance.
And then what affected our last fund, the Inflation Protection Fund?
The Inflation Protection Fund underperformed by 29 basis points for the quarter. In January, the fund was underweight UK inflation-linked bonds, which detracted, along with the fund's allocation to floating-rate senior secured loans and alternatives.
Thank you for that update, Karen. Dave, thanks for joining our quarterly webinar. As I reported earlier, we've again experienced an interesting 3 months in the economy and the markets.
Yeah, thanks, Joe. I always look forward to sharing my thoughts with our participants and institutional clients.
I'm sure our viewers would like an update on the banking crisis that arose in March. But let's start out by hearing your thoughts on the topic that continues to dominate the broader economic narrative, and that's inflation. How effective do you think the Federal Reserve has been at bringing down inflation?
Yeah, you're right, Joe. Economists and everyday consumers continue to worry about inflation. In addition, talk of recession persists, and we can discuss that later in this segment of the webinar. But before I respond to your question about the efficacy of the Fed's interest rate policy, let's take a look at the inflation numbers. I always like to begin my inflation report with a reminder to our viewers about the components that make up the Consumer Price Index, which most of us recognized as a proxy for inflation in the United States. As you can see in this first chart, housing, food, transportation together account for 3/4 of the CPI. This next chart shows the path of year-over-year increases in the CPI over the last 2+ years. Inflation peaked at an annual rate of 9% in June of last year. The federal government reported that March inflation was just 5%, which was a meaningful decline in the year-over-year numbers compared to February. It's been nearly 2 years since the annual inflation rate for the trailing 12 months was this low. So that's certainly a positive sign, Joe. However, we need to dive into the data to understand if we can feel confident that inflation will continue its descent. So on this next slide, we look at the inflation rates for those 3 categories that comprise 75% of the CPI. I'll start with food and transportation and then come back to shelter. After peaking at 11.2% year over year, food inflation over the past year was 8.5%. That's higher than we would all like, but the trend is positive. Interestingly, I read that egg prices declined last month by the most in nearly 40 years. Transportation prices are down over the past year, largely attributable to lower prices for gasoline, which is down 17%, and used car prices, which are down 11% over the past year. I should note, though, that transportation services such as auto maintenance, auto insurance, and airlines are all up in mid-teens. While the overall rate of inflation continues to ratchet lower, what concerns me, Joe, is the extent to which shelter inflation has remained elevated. To the extent that shelter accounts for nearly half of CPI, it's hard for me to envision that inflation rates will reach the Fed's preferred 2 to 3% range by the end of this year. Now, I have two more slides that dig deeper into shelter inflation, but I do want to mention the chart on the right that looks at consumer inflation expectations for the next year, which are continuing to decline. Each month, the University of Michigan conducts a comprehensive consumer sentiment survey, which includes a question regarding about future inflation. Consumers are feeling more optimistic as they expect prices to expand 3.6% over the next year, though that's still higher than what the Fed is targeting.
Before you move on, Dave, I know you've seen that the Case-Shiller U.S. National Home Price Index has declined now for 7 consecutive months. We've seen reports that rents are declining. Don't you think that we're close to seeing a turnaround in shelter price increases?
Yeah, those are all good points, Joe. Indeed, housing prices are down 4.3% according to the Case-Shiller Index. And as you accurately state, reports of actual changes in apartment rents show that average monthly rents have been declining for about the last 6 months. So let's first look at housing affordability. Although you're correct that housing prices have declined, we must not forget that interest rates for 30-year mortgages have more than doubled. So even after you consider the decline in housing prices, housing affordability, as you can see in the chart on the left, is no better than it was immediately prior to the bursting of the housing bubble and the Great Recession some 15 years ago. And on this chart, the higher the index number, the less affordable, or the more affordable is housing, and the lower the number, the less affordable is housing. Now, while the illustration on the right may not have direct bearing on housing affordability, I thought it was interesting and wanted to share this with our viewers. In January, every housing market in the eastern part of the U.S. except for Austin, Texas, saw year-over-year increases in housing prices, while Austin and every market in the West have seen declines in housing prices. Notable are the double and near double-digit increases in Florida and the double-digit decreases in California. So now, Joe, let's take a look at rents. I saw a version of this next chart recently from a company that surveys apartment owners. They estimate that average rental rates have reversed their downward trend and are rising again. The actual data could prove otherwise, but I'm not sure we can definitively say that rent costs will continue to decline. All that said, I don't believe that we are going to have 8% plus shelter inflation for the remainder of 2023. But then again, I am skeptical that the rate of inflation for housing will see a meaningful drop anytime soon, absent a severe economic downturn. So finally, Joe, let's get to your initial question regarding how effective the Federal Reserve's interest rate policy has been in fighting inflation. First, I would be remiss if I did not acknowledge that the Fed does not consider the Consumer Price Index as the best proxy for inflation. Rather, the Fed prefers to focus on the core personal consumption expenditures price index as its preferred gauge of inflation. This next chart looks at the recent history of the Fed's preferred inflation proxy. And as you can see, inflation as defined by the Fed has hovered in the 4.5% to 5.5% range for nearly 18 months. Core PCE inflation excludes the more volatile food and energy categories. During the recent bout of inflation, it's been lower than CPI inflation. However, we haven't seen meaningful declines compared to those declines that we've seen for CPI. And the Fed has clearly stated that the current level is not acceptable and it must continue to act to get inflation closer to its 2% target. Hence, up until now, has the Fed's interest rate action effectively lowered inflation? I think that the data on this chart would likely lead one to believe that there is still more work to do.
So why do you think that is, Dave? Why hasn't their aggressive interest rate policy been effective in bringing down inflation?
I guess, Joe, the best explanation I can provide is that the economy just refuses to roll over. So let's look at this next slide. Regular viewers know that I like to refer to the Atlanta Federal Reserve's forecast for economic growth. Presently, the Atlanta Fed is forecasting 2.2% growth in the first quarter. That's pretty good given all the pessimism that we saw at the beginning of 2023. What's more, as you can see on the right side of the chart, economists are continuing to forecast anemic growth for the full year.
So why is that, Dave? Why does the Atlanta Fed think that the economy performed much better than economists originally expected?
Because jobs remain plentiful and unemployment is low. I could show a lot of charts demonstrating the resilience of the job market in the face of an adverse interest rate environment. However, I'll display just one. This next chart looks at the rate of unemployment claims as a percent of the total civilian labor force. Stated differently, it looks at 55 years of history of people filing unemployment claims. The ratio of terminated workers is near historic lows, with only 15 of every 10,000 workers having lost their job in the prior week. When people remain employed, their spending contributes to a vibrant economy, but it also contributes to elevated pricing. Hence, it does not appear that the Fed's work is done.
But is this the final chapter, Dave? Do you think that there is a recession on the horizon?
Candidly, yes, I do, Joe. I'm a bit concerned that we're experiencing in the final chapter before the onset of a recession. Of all the charts I'm showing you today, this next one I think is the most interesting and the most sobering. What we're seeing here is over 60 years of history of the Conference Board's leading economic index. The Conference Board analyzes 10 different data series covering a broad swath of the economy to calculate a composite index that reflects changes in the data. This chart looks at the year-over-year change in the index. Superimposed, as represented by the gray bars, are the periods when the U.S. economy was in recession. We've had 8 recessions over the last 50 years, and in every case, the economy entered recession at or soon after the year-over-year change in the index went negative. 9 months ago, the year-over-year change went negative. Hence, if history repeats, it certainly seems that we are overdue for a recession.
So, Dave, that's not very comforting news. It seems that if you believe a recession is imminent, then you must also believe that the stock market is in for a rude awakening.
Not necessarily, Joe. First, our viewers should not assume that they are among the first to see this information. Markets are incredibly efficient, and you would be correct to assume that this information has been widely disseminated and already reflected in stock prices. It's fair to say that the market is currently expecting a recession. What remains to be seen is how severe the anticipated recession might be.
So then what do you think, Dave? How severe do you think the recession might be?
I hesitate to guess, Joe. If I had to, I would align with those who believe that we will experience a mild recession before the year is out. It may have already begun. I worry about increased consumer debt levels, and I worry about the impact of student loan repayments when they resume later this year. As you and our viewers know, however, I am an optimist. I believe that the world economy will continue along a path of modest and sustainable growth. I accept that there will be hiccups along the way, but I do believe in human resilience and the ability to overcome the unknown challenges that we will continue to confront.
Fair enough. Let's move on and talk about the crisis du jour, the banking turmoil that began with the collapse of Silicon Valley Bank and Signature Bank, compounded by the implosion of Swiss banking giant Credit Suisse. You and I posted a video conversation several weeks ago where we talked about the implications for markets and the economy. Is there anything that you'd like to add based on what you've observed in the most recent weeks?
It seems as though at this point, Joe, the fallout from the recent crisis has been contained. That said, I think it's way too early for anyone to assume that another shoe is not about to drop. Small, regional, and community banks have certainly been felt the most significant impact. The next chart looks at 3 years of monthly history of deposits into and out of the small regional banks. Unsurprisingly, we saw a spike in deposits at the onset of the pandemic when people were locked up and were unable to participate to any significant degree in the economy. Subsequently, deposits for the most part continued to flow into banks, with some months experiencing outflows as consumers found better interest rates in the bond market. But take a look at the outflows in March. It's fair to say that the bulk of these outflows are directly attributable to concerns regarding the viability of these small banks. Again, it is too early to say whether this trend will continue, but it certainly bears watching.
Thanks, Dave. That's interesting information. And before we move on, let me ask, do you think that this recent banking crisis serves as the proverbial canary in the coal mine? Do you see another crisis on the horizon?
Another good, tough question, Joe. I guess I'll defer to the experts at JP Morgan. A couple of weekends ago, I listened to a podcast with JP Morgan's investment strategist, Dr. David Kelly, and an analyst on their fixed income team. Dr. Kelly asked her a similar question, and her answer certainly resonated with me. She talked about two issues that will most certainly affect the commercial real estate market. The first and the most obvious is the work-at-home trend, which is affecting the demand for office space. But the second and more insidious concern is the expected tsunami of refinancing of commercial real estate loans. Trillions of dollars of loans must be refinanced in the near term. And given the spike in interest rates, real estate owners will most certainly feel the pressure, and the possibility of widespread defaults is real. While we don't have time during this webinar to explore this in more detail, rest assured that it is something Wespath will be paying close attention to.
Gee, thanks for that, Dave. Something else for us to worry about.
That's the nature of our business, Joe. We're always worrying about something, and our clients and stakeholders expect nothing less.
That's true. Before we close, Dave, is there anything else that you'd like to cover?
Sure, Joe. As is my custom on our webinar, I try to touch on international issues and corporate profitability. Internationally, the economic situation isn't much different than the U.S. Manufacturing is in the doldrums, but the service sector is reasonably strong. Continued inflation remains an issue, compounded by geopolitical concerns led by the ongoing war in Ukraine. Economies in the developing world don't seem to be suffering, though, as you showed earlier, You wouldn't know it by looking at the performance of emerging market stocks. Wespath remains constructive on international markets, and I would encourage viewers to take a look at my recent blog post on why Wespath invests in international securities. Now, regarding corporate profits, this last slide shows analyst predictions for the direction of corporate earnings in 2023 and 2024. Analysts are decidedly more pessimistic today compared to 3 months ago. They see profits contracting for the first 6 months of this year, modest growth in the third quarter, and double-digit gains in the fourth quarter and into 2024. But again, all of this news is known by the market and reflected in stock prices.
Well, thanks for your insights, Dave. The markets are off to a good start in 2023, and we should certainly expect more interesting news in coming months.
Thanks, Joe.
This year, we hope to highlight more of Wespath's broader sustainable investment strategies. With that goal in mind, I'm joined today by my colleague Trent Sparrow, a member of our Impact Investments team. Trent, thanks for joining us today.
Thanks, Joe. It's great to be here.
Can you start by telling us a little bit about impact investing?
Of course. Wespath views impact investing in a similar way to traditional investing. However, impact investing is more nuanced. Its purpose is to seek to create positive social or environmental impact alongside a traditional competitive financial return. It's a relatively new field, but it's growing rapidly as more and more investors are looking for ways to align their investments with their values.
So what has been the evolution of the Wespath Impact Investment Program?
Wespath's Impact Investment Program launched in 1990 with the founding of the Positive Social Purpose Lending Program, or PSP program for short. The PSP program invests in a variety of areas including affordable housing, community development, and microfinance. The goal is to create a positive investment return and positive social or environmental impact. And Wespath has made great strides towards that goal, investing over $2 billion since the program's inception. We're also in the early stages of evaluating impact investments in other asset classes, like public and private equity and listed fixed income.
Can you give us an example of one of the projects that Wespath has invested in through the PSP lending program?
Sure. One of the projects we're really proud of is 1331 Place. This is a new affordable housing development in Milwaukee, Wisconsin. The development includes 89 units of affordable housing, 18 of which are reserved for individuals with special needs. Lutheran Social Services of Wisconsin and Upper Michigan provides case management for the residents of these units, helping them access rehabilitation, vocational, and employment assistance, general health services for both medical and behavioral issues, and government benefit programs. We believe that housing is just one step in lifting folks out of challenging situations like homelessness, and we're always excited to be involved in projects like this one that provide additional social services along with housing.
This project sounds great, Trent. Why aren't there more types of these projects being built?
Yeah, the affordable housing industry is facing a number of challenges, including rising construction costs, limited land availability, and a lack of government funding. As a result, the cost of affordable housing is increasing, and it's becoming more difficult for low and moderate income families to find affordable housing.
So how is Wespath's PSP program helping to address some of these challenges?
Yeah, Wespath is addressing these challenges by providing capital to projects like the one I highlighted through our network of intermediary partners. These intermediaries are typically community development financial institutions, or CDFIs. We're an important source of capital for them and assist them in their missions to develop more affordable housing.
So zooming out a bit, can you tell us more about impacting investing at Wespath?
Yeah, Wespath's Impact Investment Program is guided by our Sustainable Economy Framework, or SEF. Our joint colleague Jake Barnett has touched on this framework in previous webinars. And for those who may not be familiar, the SEF identifies 3 pillars of a sustainable global economy. And they are social cohesion, long-term prosperity for all, and environmental health. We firmly believe that impact investing can help to create a more sustainable and equitable future. We also recognize the opportunity to align our impact investments with the Methodist values. We're committed to using our investments to make a difference in the world, and we're proud to be a leader in that effort. For those interested in hearing more from me on this, I did write a blog a few months back that talks about how we put the sustainable economy framework into practice, and that's up on our website.
So Trent, I'm sure that the blog covers this well, but for those tuning in today, do you have an example of how we're trying to implement impact investing within the sustainable economy framework?
Yes, a great example of how we're trying to implement impact investing within the SEF is the creation of our Impact Measurement and Management, or IMM tool. Last year, we created the IMM tool to help us understand how aligned or not aligned our public equity portfolios are with the SEF. The IMM tool serves three primary purposes by helping us to improve how we, number one, measure our alignment with the SEF, two, engage with our asset managers, and three, communicate with our stakeholders about our portfolios. Ultimately, the IMM is a resource that helps us understand the positive and negative impacts of our portfolio. We can then use this information to try to increase the positive outcomes and decrease the negative ones to the best of our ability. That doesn't mean we're using it as a divestment tool, though. The IMM tool is really a starting point for engagement, something that can guide our conversations we are having with our asset managers and portfolio companies around SEF alignment.
That sounds really interesting, Trent. Thanks for sharing that. Earlier, you mentioned some of the challenges that the affordable housing industry is facing specifically. When you think about impact investing more broadly, what are some of the other key challenges that come to mind?
Joe, there are a number of challenges to impact investing. I'll briefly touch on two. First, measuring the impact of an investment is not always easy. We know that the underlying data and methodologies for impact measurement are still being developed, and they will likely change over time. However, we value our IMM tool as a first step in the process and are excited to use it to make our portfolio more impactful and more aligned with the sustainable global economy. Second, it can be hard to find high-quality impact investment opportunities. Because this is an emerging area of the market, it takes some time to find opportunities that meet both our financial return targets and meet our standards for social and environmental impact.
Thank you for your time, Trent. It's been great to learn more about Wespath's impact investing program and about both the successes and the challenges your team is having in this growing area of investing.
Hey, thanks for having me. I'm always happy to talk about impact investing and the work that Wespath is doing in this very important area.
Thank you for attending the Q1 2023 Wespath webinar. We truly value our partnerships with you. If you have any questions, please contact your Wespath representative or email investmentinfo@wespath.org.